Hi everyone. In today's lecture, I will go over the topic of risk. Today's agenda is the following. First, I will backtrack a bit and kind of put in perspective of what our ultimate objective here in this class. Number two, I will introduce to you the concept of risk and return and how we plan on going about modeling risk and return. This will require us to understand, number three, probability distributions. If you have some background in statistics, you should know what probability distributions are, but if not, I will go over the basics in terms of what you need to know in order to fully understand where how the cost of capital for equity is derived. Given these definitions, of course, we won't be able to actually observe real risk or return in reality, and what we typically do in statistics is we try to estimate these parameters. So risk, we tend to model it using variance, and variance of a population is typically unobserved, and so what we do is we use historical data to kind of get an estimation or an average. Okay, so I will spend some time going over some definitions and formulas to estimate these averages. But I will go over in a separate lecture on how to actually estimate, the mean returns and the variance of using historical data that you can get from Bloomberg or Yahoo Finance. And lastly, I will go over the concept of diversification. So this is the cornerstone of portfolio optimization. And so in order to fully appreciate where the equity cost of capital comes from, we will need to understand how diversification works. All right. So a little bit more math intensive than usual, but I think the intuition should be quite clear at the end of this lecture. So let's backtrack a bit. So far we have focused on applying the concepts of future and present value on the following concepts in terms of valuation of bonds, valuation of stocks, capital budgeting, and savings decisions. Of course, what we've done so far in all of these topics is we kind of took the cost of capital for granted, other than bond valuation, right? And so this lecture and the next following lectures, we're going to try to build on top of bond valuation and to introduce the concept of risk so that we can have a discount rate to discount risky cash flows. All right. So let me write down what our ultimate goal is, or our ultimate objective in terms of modeling the equity cost of capital, and try to link with what we've understood from the discount rate that can be derived from riskless assets. Okay, so let me write down a formula first, and then I'll go over each parameter one by one. So our ultimate goal is to come up with a model for the cost of equity. Let's call that lowercase ri. So I is going to designate a specific firm or asset. And the model we're ultimately going to build is going to have the following expression. RF, F again stands for the risk-free rate that you can derive from riskless assets such as U.S. Treasuries or other sovereign debt with low likelihood of default, plus beta, I will tell you what beta is in a moment, multiplied by RM. I'm going to write RM bar to indicate the overall market return of assets minus RF. Okay, so this model, which we will get to in the next few lectures, or derive in the next few lectures, takes the following form for the cost of capital. And what this formula is actually saying is that we want to construct a model for the cost of equity such that it's an excess return on top of the risk-free rate. So to remind you again, RF is the risk-free rate. So let me write risk-free rate. And then this additional excess return is its exposure to sources of risk. Okay? So RM minus RF, you can think of it as excess returns, but there's varying degrees of this excess returns, and that depends on how exposed this particular asset or firm stock is exposed to that risk. And that's captured by this beta. Okay? So in other words, you can think of beta, so let me write here, beta is an asset's exposure to risk. Okay, so we're going to eventually build up a model using portfolio optimization math to show that beta is capturing this source of risk. Okay, and we're going to slowly but surely define what this risk should be. All right, so let me write out the other parameter definitions here. So RM is the expected market return, but because we put a bar over this RM, it's an average. Okay, so the bar on top of RM is an average. All right. So things might be a little bit more intuitive if we rearrange this expression a little bit more. So let's multiply beta through this, this excess returns expression here, RM minus RF. So let's rewrite RI in terms of, let's group it by return. So let's multiply beta through. So then it's just 1 minus beta times RF plus beta times RM bar. Okay? So based on this formula, it kind of looks like a portfolio, right? You're holding two types of assets. You're holding beta amount of risky asset, which is RM, or the overall market return, and 1 minus beta of the risk-free rate. So remember that you can have negative weights in a portfolio. That's just indicate that you are selling or shorting that particular stock. All right? So let me remind you these concepts a little bit more. So short means to sell and then buy back later. And long means to buy and sell later. All right, so when we have positive weights, it means that we are going long on a stock and we expect this stock to appreciate in value so that we can liquidate it at a future date. Whereas if you have a negative weight on a portfolio, that means you sold this stock today, but you expect to buy back at a cheaper price later in the future. So in any case, this is just to argue that it's okay to have a beta that's greater than 1. That's fine. That just means that you are shorting, or what's essentially you're doing is leveraging, borrowing money at the risk-free rate and investing in the risky stock when beta is exceeding 1, right? And that makes the cost of capital of equity excessively or more risky, right? Riskier, because it's leveraging the short risk-free rate and you're putting money in a riskier asset here. Okay. In any case, this is just to show that the idea behind the equity cost of capital is quite simple. You're allowing the firm essentially to be represented as a portfolio in which one can borrow money or invest in the risk-free rate and then invest or short the risky stock, right? And depending on how much you're investing in the risky stock is captured by this parameter beta, okay? And don't worry too much what beta is now, but that's just an insight that you should think about, all right, in the back of your head. That we're just thinking about portfolios, and once we get an idea of what portfolios represent, then our objective should be clear. We should try to construct a portfolio essentially that tries to minimize as much risk as possible given a set amount of return, right? In any case, that's our ultimate goal for today, is to talk about ultimately come up with our objective in terms of portfolio optimization. And next week, we'll talk about that topic. All right. So just to emphasize again that beta here is specific to the asset. So the asset here can be a stock return. It could be return on gold, it can be a return on corn or some other commodity, or it can be a return on some derivative, such as options on stocks or options on commodities or futures. All right, so these assets, I presume that you are covering that in your other classes, so I won't go into the detail. The objective here, again, is to ultimately figure out how to come up with the equity cost of capital so that we can construct a measure or a proper discount rate to discount the cash flows of the firm we are trying to value. All right, so let's move on to the idea of risk and return. So the central question for the next 4 weeks is going to be the following. What is the relationship between risk and return? So just thinking it through intuitively, it should be quite obvious what that trade-off should be. If something is going to be less risky, then I should be willing to pay a higher price for it, and essentially that would mean that my return will be lower. So for the same amount of price change, for example, if somehow someone can design a contract that lowers its risk, that contract was going to be more valuable, right? And therefore is going to eat away at my return if I were to buy this particular contract or asset. So to give you a more structured understanding of what I just said, let me go through an example. So suppose we have 2 types of contracts. You can think of them as contracts or assets. And also assume that there's 2 states in the world. That means the stock can go up, or the stock or the asset value can go down. So let's define what these 2 assets will give us in a two-state world, up and down. So for our first asset, let me use X1 to denote its price. We don't know what that is. Let's just call it X1. And in the future, this asset can appreciate to let's say $10, or it can go down to 0. Okay, and let's assume for asset 1, there's a 50% chance that it will go up by 10, and a 50% chance it will go down to 0. Okay. For the second asset, let's hold the outcomes the same. Okay, so it can also go up by 10, or it can go to 0. But the probabilities, or the likelihoods of going up and down, I'm going to assume is going to be different. And this is what's capturing the risk value of the risk difference between these 2 assets. So suppose for asset 2, the likelihood this asset will go up is 3/4 or 75%. And the likelihood that it will go down is 25%. Okay? So this is a very simplified model. Okay? We're talking about just two time periods, today and 1 year for today, for example. And there's 2 possible outcomes, up or down. The only difference between these 2 assets is simply its variance, right? And I'll show you what the variance of these 2 assets are soon. But the idea is clear, right? Same outcomes, different likelihoods, and this likelihood is capturing, as I will show you, the variance or spread of our return. So let's assume for now that the discount rate is 0%. So given this gamble, okay, you can think of these 2 assets are gamble. What should be the fair price you would pay for these gambles, right? So if you've taken some statistics, you should know that we simply take the mean, and that should be the fair price. Because when we talk about the mean or fair gamble, we're talking about playing this game over and over again. And if we can play this game infinitely, what is my break-even amount of money that I can get, and that amount should be the price of this gamble. So for asset 1, the mean or the price of this lottery or gamble should be the following. So I'm going to use E for expected value or expectation, and this will designate our price for asset 1. So asset 1 has a expected value of 1/2 times 10 plus 1/2 times 0. And that's going to give us a price of 5. So what that means is that if I was given the chance to play this game, I can either get $10 or get nothing. I should be willing to pay $5 to break even, right? That's if I were to play this game infinite times, right? If I paid a price anything less than 5, I would always get positive expectations. So if I play this game enough, I will have some money in the end. So the question here is asking you, how much should I pay so that I break even? And that answer is 5. Okay? That's going to be essentially our price of this particular asset. So for asset 2, the mean is also computed the same way. So x2, the expected value of x2, is 3/4 times 10 plus 1/4 times 0. And this will give us a price of 7.5. So already we kind of see what's going on. So something that's less risky obviously is going to cost more. And if we calculate the returns, asset 2 is going to have a lower return than asset 1 because of a lower risk, right? Just because there's a higher likelihood of the asset increasing its value over time. And so let's quantify the variance. So let me go over the definition of variance for asset 1 and asset 2. So the variance of asset 1 is the following. It's 1/2 times the demean value when the asset goes up. So 10 minus 5 squared plus 1/2 times 0 minus the mean squared. And that's going to give me 25. Okay. Similarly for the variance of x2, that's going to be 3/4 times the demeaning of the value of the asset when it goes up squared plus 1/4, the same thing but with 0 now. And that's going to give me 18.75. So just to be complete, let's calculate the returns. All right. So the returns for asset 1, I'm going to designate using R1. So for asset 1, the returns can be 10 minus 5 over 5. Remember, 5 is the price of the asset when presented with the at time 0. So that's going to be 100%. And the return when the asset goes down is negative 100%. And if we take the average, let's do R1 bar, that's going to give us a return of 0 on average. But for R2, we have 10 minus 7.5 divided by 7.5. That's going to give us 33.3%. And 0 minus 7.5 over 7.5. That's going to give us negative 100%. Right? If we take the weighted average based on the likelihood of the asset appreciating or depreciating in value, so for asset 1 it's 1/2, 1/2. For asset 2 it's 3/4 and 1/4. The mean return for asset 2 is going to be negative 0.25%. So already we see that for asset 2, the return is lower because of the higher price, right? But its variance is lower as well. So there is a positive relationship between risk and return here, obviously, because the price has to adjust for it. Okay, or it has to compensate for the less risk. You can think of it as insurance. Okay, so that's our task today, is to show that there is a positive relationship between risk and return. And so for the next few slides, I'm just going over these definitions. What is the expected value? what is a probability distribution, and what is variance capturing, which is our primary way of viewing risk in this class. So let's look at some data of what this risk-return relationship looks like for an array of different assets. So on slide 6, I give you 6 different assets or asset classes. The purple line is CPI, or the Consumer Price Index. That's just the inflation. You can think of it as just inflation. The green line represents the returns for treasury bills or short-term risk-free rate. The yellow line is corporate bonds, so those are fixed returns, but they're risky because it's supposed to capture the likelihood of firms defaulting. S&P 500 is the top 500 assets or stocks being traded in the US, and this is capturing the market return in the US for US companies. The red line represents small stocks for around the world, and small stocks meaning these are low market capitalization, these are small firms and therefore more risky. Okay, and lastly, the world portfolio is a portfolio of all stocks for all firms across the world. Okay, so what this graph is essentially showing is a sorting of risk across different assets, and what we see here is an ordering of returns. So what's plotted in the x-axis is time from 1925 all the way to 2009, and in the y-axis I'm showing the value of your investment if you were to deposit $100 in that particular, or investing that $100 in one of these particular assets. So if you see from CPI, which is the purple line, this essentially represents just putting that $100 in a checking account and allowing that checking account to, its interest rates may fluctuate depending on what the inflation is and depending on what the central bank is adjusting its interest rates to. And so if we deposit $100 in that checking account over 80 years, we would only get $1,174. But as we move into different asset classes that are riskier, we see that $100 return increases substantially. So moving from CPI to treasury bills, we get a much higher return, $2,000, right? Moving then into corporate bonds, which is slightly riskier, but still safer than stocks, right? We see that it jumps all the way to $16,000. Moving into the world portfolio, which is diversified, meaning that our risk is somewhat spread among different assets, we get $85,000. But once we jump into riskier stocks and we get more specific into a particular asset, a country such as S&P 500, the stock starts to rise substantially, right? $85,000 all the way to almost $200,000. And if we put our money into even riskier assets, such as small stocks, which are not only less liquid than these, popular stocks such as, Baidu and Tencent or Apple and so forth, these stocks tend to provide higher returns. Again, you want to be compensated for riskier assets, and that's why we observe, in reality, a higher return. Okay? All right, so before we get into actual data, let's go over some definitions of how we're going to go about defining what return is, defining what risk is, and we're going to do that through understanding probability distributions. So first things first, let's talk about what we want to model. What we want to model here is not the price per se. We want to model returns, okay, so that we can make comparisons across different asset classes, rather than if we only looked at prices, then that's not helpful, right? Because price levels are determined based on supply of that security. And so what we really want to look at here is returns. And we define returns in the following way. we define it simply as the price plus any intermediate cash flow that you get from the next period, and looking at its percentage return, right? So return is equal to P1 plus CI divided by P0 minus 1, which can also be written in the following way, which is probably more intuitive. P1 plus C1 minus P0 over P0, okay? So this part is the, the price of an asset in the next period, plus, so C is supposed to capture, interest payments or dividend payments, minus P0, which is the initial price at time 0, divided by P0. And this entire expression represents a percentage return. So let's try to model R, okay, rather than P directly. So a little bit more intuition here, or explanation here. We want to pin down the relationship between risk and return, and therefore we need a good definition of risk. So, but we first need to figure out what this variable we want to understand risk from. Price and cash flow in the future are uncertain, and therefore returns are also uncertain. And so we want to try to understand returns in terms of different outcomes and try to assign likelihoods or probabilities. So probability distributions of returns just means that the return of a particular asset can have a sort of change over time, and those changes depends on different states in the future. In the example I gave you, we only had 2 states of changes, right? It can go up and go down, but you can imagine there are 3 states in which a stock can stay the same, go up and go down, or have a a continuum of outcomes it can take on, right? It can take any value between 0 and 1% increase. So that's what we kind of want to introduce to you now. How do we model uncertain outcomes? And what we first have to do is to define what a random variable is, and this is intimately tied with the definition of probability distribution. Okay, so let's go over an example first. So let's try to understand the stock return of a company called BFI, and we're going to try to assign a probability distribution for 3 possible states. So let's look at this table, right? So in the first column, we have the assumption that this stock at time 0 has a price of $100. In the second column, we presume that this price has 3 different possible outcomes. Price of today can change to a price of $140, $110, or $80. Okay? And we can calculate these returns outright simply by taking 140 minus 100 divided by 100, 110 minus 100 divided by 100, or 80 minus 100 divided by 100. And that's what the third column is telling us. There is a realized return depending on which state this stock will realize. Okay? And once we have these return outcomes, we can then try to assign probabilities in order to figure out what the mean and variance of this particular asset or stock is. Okay? So based on this table, it seems that the stock has a 25% chance of moving from price 100 to 140, a 50% chance that the stock goes from 100 to 110, and a 25% chance the stock will decrease to 80 by 25%. Okay, so given these information, we should be able to know the mean return of the stock and also its variance. And these are our ways to capture risk and return in this class. Okay, so if we want to represent this probability distribution in a graph, we can, and this will look like something you've seen before in your Introduction to Statistics class. Right? So in the x-axis, we have possible realizations of this stock, it can decrease by 20%, it can stay the same, it can increase by 10%, or it can increase by 40%. But the likelihood, there's a distribution, right? It has a 25% of decreasing, but a 75% chance of increasing. And of course, this assumption is quite strict because we only assume there's 3 states in the world. In reality, we can assume there is a continuum. And so those of you who've seen a continuous distribution before, we can actually model it, make it look like a bell curve or something like that. But in any case, for our purposes, at least for exam purposes, we won't be talking about continuous distributions. Everything will be discrete, and so the calculations should be very straightforward. And we will go over those definitions right now, okay, for discrete cases. So discrete, to be clear, discrete just means that each state there's a finite number of states, okay? Finite number of states or possibilities, and we will assign likelihoods to each of those states. Continuous means that there's essentially infinite number of states to consider, and we have to have a function, right? We need to have a function to actually map a likelihood to each possible return number, okay? So sometimes you've seen people write, f of r, for example. R is the return, and f returns the likelihood. And we need a function to capture that. But in any case, we won't be discussing that in this class, okay? We won't be defining probability functions here. Okay, so how do we calculate the mean return of a stock using discrete probabilities? So we can't know exactly what a stock's return will be in the future, right? That requires being able to see something into the future. So what we typically do from portfolio managers' perspective is we try to make a best guess. And this best guess is captured by expected return or mean return. Remember, mean return means that if we were to observe this stock over and over again from time 0 to time 1 or time 1 to time 2, we should see a mean decline or drop in the stock, right? There is a consistent behavior of this stock that should stay the same over time. And this is what expected return is capturing. And we can calculate this expected return by simply taking the weighted average of returns based on the probability distribution that we assign to each of those states that we talked about. Okay, so in the table for BFI, remember that we assigned 25% chance in which a stock would decline by 20%. So these are the numbers here, right? 25% decline in 20%, a 50% chance of a 10% increase in the stock, and a 25% chance of an increase of 40%. So we're taking the weighted average of the return according to the probability distribution, and we should arrive at an expected return of 10%. Okay, so as the last sentence states in this slide, the expected return is the weighted average of the possible returns where the weights correspond to the probabilities. For those of you who are curious what this expression looks like for a continuum of probabilities, it would look like the following. Okay, so this requires some understanding of calculus or integrals. Okay. So R is our return or random variable that we don't know. It has a continuum of states. That's why it's -1 infinity and infinity, right? Because all returns can, be negative 1,000% or 2,000%. It could be positive 3,000,000%. Those are all possible likelihoods. And then we multiply this return by the function, the probability function. So let's do f of r. And then dr just means that we are summing this continuum. So This is what this integral means. We're summing all these multiplication of the probability function for r times the return for that particular state. Okay. In any case, I won't be asking you to use this formula, but for those of you who are interested, this is what the expected returns looked like for a continuum of returns. And I know some of you are taking stochastic calculus, so this should be something that's not so foreign. Okay. All right, so that's our way to calculate return, or estimate or measure return. What about risk? So in this class, as I mentioned already, we're going to focus on one particular dimension of risk, namely its variance. So variance is measuring the average deviation away from the mean squared. Okay, that's what variance is. So let me reiterate. The variance is measuring the deviation from the mean return squared, an average over every state. Okay, it's averaged according to the probability distribution that we assign, or that's given to us. So let's go over the example with BFI. Recall the table again, that we have a 25% chance of the stock declining, 50% chance of the stock increasing by 10%, and 25% chance that the stock will increase by 40%. And that's where we see these weights, right? So whenever you see the expectation symbol here, so the E, whenever you see the expectation, what we're doing is we're taking a weighted sum according to the probability distribution. And as I stated already, the variance is capturing the deviation of the return for that particular state away from the mean and then squaring it. That's why you see the square here, and that's why we see the mean here, right? We're subtracting the mean from the realized value of negative 20%, 10%, and 40%. And so the standard deviation is simply the square root of the variance. This is often called volatility. Okay, so I will use standard deviation and volatility interchangeably in this class. So for the example we discussed in the previous slides, the standard deviation of the BFI stock return is 21.296%. And to summarize, the final sentence in this slide states that the variance or standard deviation measure how spread out the possible returns are. And we typically refer standard deviation as return volatility. Okay, so let's do some simple examples. So let's compare return distributions across different assets now, or stocks. So let's now add to the picture or example in the previous slides. Suppose there is a stock now called AMC, and it has the following distribution. So like BFI, it has a starting price of $100, but it has only two possible states that can be realized in the future. The stock can go up to $145, or the stock can go down by $75. We can calculate the realized return by taking the difference, 145 minus 100, and dividing it by the initial price of 100. That should give us 45% realized return if the stock goes up, and a negative 25% if the stock goes down to 75. And we're going to assume that the probability of going up and down are the same, 50-50. Okay, 50% going up and 50% going down. So what this slide is asking you to do now is to calculate the expected return and the return volatility for AMC stock. And then number 2, decide which stock you would rather invest in, AMC or BFI. So let's go ahead to calculate the solution to number 1 first. So on the next slide, slide 15, the expected return for AMC is expectation of R, which is equal to 50% chance that the stock will increase by 45%, and 50% chance the stock will decline by 25%. So the expected mean is 10%. So it's the same, right, as BFI. The variance, however, to reiterate, is simply calculated the same way as before. We're taking the weighted average of the deviation away from the mean squared for each possible state of realization. So in the case in which the stock increases by 45% chance, we demean it, we subtract 10%, and then we square it. For the case in which the stock declines by 25%, we again demean it by 10%, and then we square the difference. And then take the weighted average, we get 0.1225, and then square rooting this variance, we get the volatility, or standard deviation, and that gives us 35%. And if we compare this volatility with the volatility of BFI, you'll see that this stock has a much higher variance or standard deviation. And therefore, for the same return, AMC is riskier based on this metric, based on variance. Okay? And so if I was an investor, I would choose to invest in BFI if I had a choice between BFI and AMC. Okay? All right, so as you know, we often don't observe the probability space, right? We don't know how the distribution of likelihood is allocated in reality. And so in order to estimate returns and variance, we have to take averages using raw data. So number 4, we talk about historical estimating returns and volatility using historical data. So as I mentioned in the homework assignment, right, we don't observe the so-called population variance or the population mean. What we have to do is rely on historical data to estimate, substitute values. Okay, and this is the best we can do. In order to actually get accurate estimation of the mean and variance or standard deviation, we typically need lots and lots and lots of data. And this is fairly problematic in finance because, to be honest, if we're thinking about asset returns, it's not about millisecond returns, right? That's not very helpful. We're talking about very long periods of time returns in order to actually truthfully gauge the performance of an asset, right, in terms of mean return and variance. And this is hard to come by, okay? Especially if an asset that was just recently being traded, such as a stock issuance, it's hard to gauge or IPO, it's hard to gauge how risky that firm is just based on a few months of trading. So let's look at how we should go about estimating the average return, given that we have to rely on the available historical data that we can access. So we can easily collect this data from Bloomberg or from Yahoo Finance or from WINS or whatever. There's many platforms that collect stock data, so that's something that's very easy to do. So in order to estimate the mean return, what we typically use is what's called the sample mean or the sample average return. And that's simply summing up all returns over the interval period we're looking at. Typically we look at daily or monthly returns, okay? And we simply take that and scale it by the number of time or periods that we're observing. So T here can be the number of months or the number of days of a particular asset that we're looking at. The sample average standard deviation is done the same way. However, remember from last week's or homework from last 2 weeks, we take, rather than scaling it by 1 over t, we are scaling by t minus 1. Okay, this is again a correction so that our mean estimation is not biased. Okay, so r hat here represents the sample average return, and also remember for the standard deviation, we're square rooting the variance. So the variance again is simply the deviation of the observed value from the sample mean. and squaring it. And then to get a estimation, we take the average, but the average is for t minus 1 periods rather than t. Okay, so the example exercise that I give you is in an Excel sheet called historicalreturns.xls. So I'll let you have some time to work that through. But let me summarize. Let me just go over the steps, what I expect you to do, and then I'll let you guys do it yourself, and then I'll go over it in our weekly Zoom session. Okay, so what I have for you in the Excel sheet is the following firms. You have a lot of famous companies here. You have Boeing, you have Apple, you have Procter & Gamble, Walmart, Microsoft, and banks such as JP Morgan. Okay, and your task here is to take the returns that I've gathered for you and to compute the means and standard deviation, or the mean return and the volatility of each stock. And then we're going to try to construct a very naive measure of the market portfolio. Just using these stocks. So we're going to presume that the market portfolio is represented by these stocks. Okay, so step 1, for each stock and for each month, I asked you to calculate the return. So once you get the price, you should adjust it. We should compute its first difference, meaning take the price in the future, subtract the price today, and divide by the price today, minus, and that should give you the return. Okay? And then for each stock, we can calculate the average and standard deviation using the Excel function that we talked about 2 weeks ago. So make sure to use the sample standard deviation because we want an estimation that is unbiased. Okay? Number 3, you should convert these standard deviation terms or return estimations into annual terms. Okay? And number 3 tells you to multiply the monthly return by 12 because the return is for each month. So we just extrapolate it to 12 months by multiplying it by 12. But remember to only multiply the standard deviation by root 12. This is because we assume that the variance is linear. The variance is going to be linear with time. Okay, this is just an assumption that's based on a continuous time model. Okay, so for those of you who are taking stochastic calculus, knows what I'm talking about. Otherwise, don't worry. This is by assumption. We are simply assuming that variance grows linearly with time. So let me be clear. Assume that variance is proportional to time. So that means we can simply scale the monthly variance into annual terms simply by multiplying by the number of months you want to extrapolate to. All right? Number 4, calculate the average return of the stocks. This is the return of an equally weighted portfolio. So what this means is, suppose that we want to hold equal amounts of the stock in the Excel sheet, and then just estimate, and then just calculate the average return, assuming that we are equally invested in all these stocks. Number 5 tells you to calculate the sample average and standard deviation of this naive equally weighted portfolio. And then 6 tells you to verify that the average of the samples returns to the individual stocks is equal to the same average of the portfolio return. But then number 7 tells you to notice that the standard deviation of the portfolio returns is going to be most likely less than the average standard deviations of the individual stock returns. And the intuition here is that by forming this portfolio, a lot of the stocks are going to be not perfectly correlated, and this is going to help address the variance here. Okay, so imagine you have one stock that has a certain type of variance, another stock has a certain type of variance, but the stocks compared to each other has also some correlation, right? They can move together. But if they move in opposite directions, then there is some risk benefit from holding these two stocks together because they move in opposite directions, right? If they move in opposite directions and we holding both of these stocks, then our portfolio together with these two stocks is not going to change very much, right? And so that's where the benefit comes from the risk benefit from holding these two stocks rather than just holding one of these stocks individually. If there's imperfect correlation between stocks, there is going to be a risk benefit from adding additional stocks in your portfolio. That's the kind of insight what this exercise is trying to bring to the table. Okay, so on the topic of diversification. So in the exercise that you will complete on your own, and we will discuss next week in our Zoom session, what the exercise that we're going to talk about this coming few days is the benefit of diversification. Okay, so why is this important from a corporate finance perspective? So recall that our objective here is to come up with a proper discount rate for the cost of capital. But it's important to realize that we have to incorporate specifically the kind of risk that should be priced. So there are certain types of risk that can be eliminated from the perspective of the investor. Okay, and this kind of has this perfect market, assumption in the background. But the idea here is that under close to frictionless market imperfections or few market imperfections, we should have a scenario in which investors have a way to eliminate some of their risk by incorporating different assets into their portfolio. Okay, so this is what diversification is. It's the elimination of risk through adding different stocks into your portfolio because of imperfect correlations between stocks or assets returns. So the big picture. So let me give you the big picture again. Why is this important? This meaning diversification, important for corporate finance. Let me write out corporate finance. Corporate finance perspective. Remember our objective. OBJ stands for objective. Our objective is to find discount rate for risky cash flow or risky returns let's say find the true discount rate for risky returns. Okay? Risky cash flow returns. So that begs the question is, what kind of risk should be, put this in quotes, priced or captured by this discount rate? So to give you a brief overview, there's two types of risk that you should think about at this moment. The first is risk that can be diversified, and then risk that can't be diversified. So I'm going to call this undiversifiable. Let's call this diversifiable and undiversifiable. So under the assumptions, we have a close to perfect markets in which there's perfect information. There's not that much transaction costs. Investors can buy and sell infinite amounts of any assets. They can short, they can long, whatever. Investors should be able to construct portfolios to eliminate diversifiable risk. Okay, that's the key takeaway here. Under certain market conditions, or even in weak conditions in which there are some transaction costs, that's okay. Investors can still formulate portfolios of assets that have imperfect correlations that is able to eliminate diversifiable risk. That's the key insight here. If investors are allowed to eliminate diversifiable risk, then the discount rate should only be capturing undiversifiable risk, right? Because investors can simply eliminate diversifiable risk by diversifying, by incorporating assets that have imperfect correlations with other assets. They can keep doing that until you reach a certain point. Whatever is left is undiversifiable, and that risk must be priced into or incorporated into the discount rate. That's the key takeaway. That's the intuition behind the model that we're trying to get to. Okay? And the assumptions here assuming perfect markets, roughly perfect. We'll go over what perfect markets mean later on, but you should think of it as simply barriers so that people can make transactions and formulate portfolios and incorporate information. So for now, just think about it in those terms. But even in imperfect market conditions, you can still formulate portfolios and diversify, diversifiable risk. And we're essentially assuming that diversification is essentially costless. Right? So firm specific, or sorry, let me write risk diversifying is roughly costless. I'm going to use this approximation here, costless. And can be eliminated by investor and should not be part of equity or whatever cost of capital for that particular asset. But it's probably easier to think about this in stocks, okay? So what this means here, diversification, is that we can simply average out this sort of risk, if this risk is asset specific or firm specific, by simply incorporating other stocks that are not perfectly correlated into your portfolio. I will demonstrate this using some very simplified math in a few slides. Okay, so let's now look at historical evidence of this positive relationship between risk and return, and to provide you an example of what a portfolio return looks like. Okay, using the math, and then showing you what correlation coefficient looks like between two stocks. Again, so we're just going over definitions for now. Okay. All right, so historical evidence. So this picture is taken directly from the textbook. So stocks 1 through 50. Stocks 1 through 50 is the, let's see, stocks 1 through 50 are the largest market cap, top 50 market cap according to the S&P 500. Okay, so that's represented by the yellow triangles. The blue squares are stocks, the top 50 to top 50 to top 400 stocks, and the orange represent stocks or firms that are in the top 400 to 500 stocks. Okay, so the y-axis here is historical average returns, and the x-axis is volatility. So let me use some symbols here so that it's clear. So R bar represents historical average return for each of these stock, and historical volatility, I will use sigma. Okay, so sigma is standard deviation, right, or volatility. And just to remind you, I'm going to use sigma squared to represent variance. But for the x-axis, we're looking at standard deviation. So just based on this graph, it should be quite clear that there is a positive relationship between risk and return. If we look at, if you look across different asset classes, so if you look at small stocks, mid-cap stocks, corporate bonds, treasury, it falls on a line, right? It sits basically on the line. So there is a linear relationship between risk and return. But when we look at stocks in general, we see that it's kind of scattered all over the place, but it still has a, its relationship is still positive, right? But not perfect. But what you should notice here is that the top 50 stocks are clustered in this kind of area, and as I will show you later on, stocks along this so-called frontier tend to be the most risk efficient. Okay, once we get to risk efficient, meaning for the same return, the variance is as small or as small as possible. But as we move to less efficient stocks or assets, meaning for the same return you might get more variance, they are mostly captured by stocks in the bottom 50 to 400 in the S&P 500. So that's represented by the blue squares and the orange circles. So the question that you should be asking now is, can we build a portfolio that is risk efficient? So that's kind of the next step for next week. But in any case, for today, we're just going to be talking about definitions. So what's a portfolio given the stock? Portfolio is simply defined as the amount of the asset or stock you are holding. So what is a portfolio? It's just holdings. But okay, so let me write the question you should be thinking about is, can we build a portfolio that is risk efficient? And what I mean is fix R star and then minimize sigma. The answer is, of course, is yes, and we will go over that math next week. All right, so let's look at portfolio returns rather than just returns on one specific asset. Okay, just so that we can understand the mathematical structure to represent correlations between assets within a portfolio. So suppose we have two stocks. We have stock A and stock B, and they have price 1 and price 0, right? To indicate the price 1 period later and price today. The returns is simply the difference in the price between these two periods divided by the initial price. Okay, so that's P1 minus P0 divided by P0. Straightforward, right? And so if we have a portfolio of stock A and B and we invest $1 in each stock, we can calculate its value over time. So in this table on slide 25, we see that we hold $1 divided by the price of stock A shares, right? And at time 0, it has $1 value, obviously. Same for stock B, we're holding $1 divided by the price of stock B shares. And at time 0, again, just $1. But over time, it's going to grow by RA and RB. So we simply multiply 1 plus RA and 1 plus RB times that $1, and that should give us the final price in the future. Okay, so just to be clear, this is equal to 1 plus RA, and this is equal to 1 plus RB, right? It's like putting money in this asset, and it grows one period, and so it's 1 plus that percentage rate. Okay. So if we were to calculate our overall return for this portfolio, we simply aggregate the value of our portfolio at time 1, subtract our initial investment, which is $1 for each asset, so that's $2, divided by our initial investment, which is $2. And if you rearrange this equation a little bit, for example, we could move this $1 here and move this $1 here, right? So that's plus 1 plus 1. Then it's going to look like returns, right? We're simply taking an average of, we're just taking an average or weighted average based on how much we are holding in each stock in order to achieve our portfolio returns, right? So it just looks like 1/2 in asset A and 1/2 in asset or stock B. Okay, straightforward, right? It's all right, so let's suppose a little bit different now. Suppose we have, again, stock A and stock B, but instead of $1 each in each stock, we now hold $10 worth of stock in stock A and $30 worth of stock in stock B. And so our holdings, again, simply taking the value we're investing in, dividing it by the price for both stock A and stock B. And so our value today is simply how much we decide to put in each of the stock, and we multiply the percent return, right? So 1 plus RA. I mean, this term is 1 plus RA, and this is 1 plus RB. And we multiply that return for the amount of money we've allocated for each of these assets. Okay, similarly, in order to calculate the return, we add up our portfolio weighted assets. If we decide to liquidate it in period 1, that's $10 times the ratio of the prices plus $30 times the ratio of the prices for stock B, minus our initial investment, which is $40, and then dividing it by the initial investment amount, rearranging the terms again. That is distributing this minus 10 here and distributing this minus 30, sorry. It will look like as if we are taking a weighted average of the raw return, right? 1/4 in stock A and 3/4 in stock B. So all that matters really is the relative amount of money you allocate, right? So total $40, but this is our total portfolio value at time 0, but it's the proportion that actually determines the overall return of your portfolio. Okay? Simple. So just to summarize what I just showed you, we can take the general case in which we have a portfolio of multiple securities. It can be stocks, it can be bonds, whatever, but for our case, let's just think about stocks. The our portfolio weight, is therefore simply the amount invested in security I divided by the total amount of investment you're committing to the portfolio. So the return of the portfolio is simply the weighted average return given our initial weights at time 0. Okay? So once we have this definition of a portfolio, that is a weighted average of returns of stock, it's very easy, therefore, to calculate the mean and variance of our portfolio now, right? We can simply use the properties of expected value and the properties of variance. So if you don't recall the definitions of variance and mean, let me review it now. Okay, so before I get into mean and variance, let's go over covariance and correlation first. So covariance and correlation is just looking at how two assets are moving together. It looks like variance, but rather than squaring itself, we just multiply deviations from the mean with these two different assets. Okay, so if we look at the definition here for covariance, it's simply the demean of return of asset A and the demeaning of asset B, and then multiplying them together. And then we take a weighted average depending on our probability distribution that we assume to be. Correlation is simply, again, just scaling this covariance by something. It's like square rooting variance, okay? So in order to get the correlation between two assets, we scale the covariance by the standard deviation of each asset. Okay, so these are just definitions. Scaling this, therefore, just makes the correlation fall between two numbers. It falls between -1 and falls between +1. Okay, so if something that has 0 correlation just means they don't move together at all. Okay, and so if one stock moves in a certain direction, that stock doesn't change or at all. Okay, so that's 0. That's what we get here. Sorry. But if two stocks move together slightly, then we will have a correlation coefficient that's greater than 0. Conversely, if two stocks move in opposite directions, we will get a negative correlation. So you can kind of see where diversification is coming from now, right? It's coming from the fact, most importantly, coming from the fact that two assets may actually be negatively correlated, and that's going to help reduce the volatility of our portfolio. Okay. But even anything less than perfectly correlation is actually beneficial for our portfolio. So let's move on to calculating the variance and standard deviation of our portfolios. So recall the properties of variance. It's very straightforward when everything is linear, and when we have a portfolio that is simply defined as a weighted average of returns. It's very easy to kind of break down our portfolio variance into separate components. So if we look at this definition here, in the two asset case, we have the variance of portfolio equal to the variance of 1/2 times RA plus RB. So this is the case in which we have equal weights in stock A and stock B. Recall that when we have a constant term multiplying a set of random variables, we can take it out of the variance function and square it. So that's where this 1/4 comes from. And then using the property of variance, we can just take the variance of each component and add an extra term for its correlation. All right. This is like how well these two assets are correlated with one another. If they're not correlated at all, meaning they're independent, they don't move together, then this could go away. It could be 0, right? But if they're very correlated, like perfectly correlation, then that's going to enhance the volatility of our portfolio. So to calculate the volatility or the standard deviation, we simply take the square root of the variance. So that's why we get this 1/2 back, but we get this square root symbol on top of this variance expression. So what you should notice from this expression is this term here. This is where diversification comes in. Okay, comes in. So if they are very correlated, you can see that the volatility can increase. But if something that's very close to 0, then we get this will actually reduce the risk of our portfolio. All right, so let's look at the generalized case for the arbitrary weights for 2 assets or 2 stocks. We just simply substitute that 1/2 with XA and XB, and everything shouldn't be too surprising, right? Okay, so let's look at a formal definition of diversifiable risk and undiversifiable risk using some math. But first, let me just premise the math with some definitions, okay, some intuition, qualitative understanding. All right, so what we typically like to characterize as diversifiable risk is risk that's only specific to one particular firm. You can think about things like earnings announcement, like the firm decides to announce something that's related, announces profitability over a certain period. That's kind of specific to that firm only, and it's not really, may or may not be correlated with other firms. Things like data hacking is also very firm specific, so any damage done to a firm's performance as a result of data hacking is specific to that firm, and it's not going to spread to other firms. This is not correlated with the general markets. Additional things like product recalls as well, that's something that's firm specific, or even acquisitions. Okay, so these things are things we typically assume to be diversifiable. We can eliminate or average out these risks simply by incorporating more firms or more assets or stocks into our portfolio. So let me write down the examples here. So things like data hacking, product recalls, earnings announcement, acquisitions. These are things that impact that particular firm only and not necessarily any other firm. However, there are other things that kind of impacts everyone all at once. Okay, this is the kind of risk that cannot be avoided and therefore undiversifiable, no matter how many firms you decide to add into your portfolio. So things like trade war or actual war, like World War I, World War II, or credit crunch. Credit crunch refers to the collapse of the financial markets, financial crisis, right? Financial crisis. These are events that will impact all firms, so this is inescapable. No matter what kind of firm you decide to add in, that firm will be exposed to that risk, and therefore that risk cannot be diversified away. Okay, so the next slide, therefore, just simply summarizes that intuition. So we call diversifiable risk, or also as idiosyncratic risk, meaning it's specific to only that particular asset or firm. And we call undiversifiable risk as systematic risk, meaning that it impacts the entire system, and you can't eliminate it simply by adding different assets to your portfolio, because all assets are impacted by this source of risk. Okay, so what we want to do, therefore, is only come up with a discount model for risky cash that captures this systematic or undiversifiable risk, because we assume that investors are able to construct portfolios to eliminate idiosyncratic or diversifiable risk virtually costlessly. That's the underlying takeaway from this lecture, okay? So let's give some, so let me clarify some of these bullet points. So stocks that only have idiosyncratic risk will be uncorrelated. So you can think of this scenario in which the correlation coefficient between stocks is 0, right? So if that's the case, then your variance or your standard deviation of portfolio is simply the sum of the standard deviation of your assets or stocks. If stocks have only a market-wide risk and they'll be perfectly correlated, then we have a correlation coefficient of 1, right? In this case, your portfolio is therefore, could have much more risk than you wanted, right? You might as well just only hold onto one stock if you want to kind of mitigate risk here. And stocks that have both risks will be somewhere in between. And that's where we want to be, right? We want to kind of only be exposed to this correlation coefficient, right, which could be between 0 and 1. So let me clarify what I said up here. This, you can think of it as can be eliminated by investor by adding less correlated stocks. Okay, that's kind of important. As long as the correlation coefficient is less than 1, it could be beneficial for your portfolio because you're averaging out the risk. So let's go over an example using some math here. Okay, and this is where this picture comes in. So let me tell you what our portfolio is going to look like and what our assumptions are, and then the graph here will be clear. So let me use the appendix here to write down our setup. Okay, so let's look at the graph first. So recall that in this picture, the x-axis is the number of stocks and the y-axis is the volatility of portfolio as measured by standard deviation. Okay, so let's reinforce that assumption here by writing it down. So x-axis is defined as the number of stocks and the y-axis is sigma, or standard deviation. Okay, and let's represent the number of stocks using n here. Okay, n is the number of stocks we're going to incorporate in our portfolio. And we're going to assume, to make things simpler, that the variance of all stock, so let's just do sigma squared is equal to sigma I squared, which is equal to 0.09. Okay, we're just plugging this arbitrary number here, and that's what you see in this graph. Okay, we're assuming that the variance of every stock is the same, and it's going to be 0.09, and which means that the standard deviation for all stock is 0.3, and we're also assuming that this correlation coefficient is the same between all stocks. Okay, so any pair of stock I and stock J is going to be the same. Okay, and recall that this correlation coefficient is defined as the covariance divided by the standard deviation of stock A and stock J multiplied. And since we assume that the standard deviations are the same across all stocks, that's simply covariance divided by sigma squared. All right, so given these assumptions, our portfolio math is going to look much simpler. So let's look at this volatility of our portfolio, which is defined as the square root of the variance. And then we write just portfolio here. That's going to be equal for the general case of for n stocks. Let me write out what I derives. You should actually double check and make sure you get what I get. Okay. 2 times n factorial, 2 factorial, n minus 2 factorial times 1 over n squared, sigma squared rho. Okay. This expression here is just the covariance. And this is the portfolio weight, 1 over n. Remember, when we take out a constant from the variance function, you have to square it. Okay, and this is, you can think of as the permutation, okay, permutation of all assets, right? Okay, so we can actually simplify this expression a little bit more in the case of, so it's kind of trivial in the case in which n equals 1. If n equals 1, then it's simply the variance, right? But for n equals 2 or greater, we can simplify this expression to the following. So this there should be a square root here, sorry. So this should therefore be square root of 1 over n times sigma squared plus 1 over 1 minus n sigma squared rho. Okay? In the case of n greater than 2, you can work out the math yourself. It's quite straightforward. It's just algebra. And to demonstrate the power of diversification, let's just take n to the infinity here. So we can take the limit here. So let's take the limit as n goes to infinity. As you all know, as n goes to infinity, 1 over n will be 0. So this term goes away. And similarly, this term goes away. And at the end of the day, we will be left with sigma square root rho. Okay? So if you plug in 0.09 and 0.03 in here, or 0.03 here, you will get the numbers that correspond to the graph. This graph here. Okay? So as we add n, so as n goes to, a large number, it will converge into a specific number. So I plug in we plug in for different rows into this equation. So recall this equation. So sigma, we know what that is. That's 0.3. We plug in, we plug in different values for rho, and we will see where it converges. And if you plug in sigma equals to 0.3 and rho equals 0.3, you'll see that the limit takes your portfolio volatility to converge to some number around 0.16. So this is around 0.16 volatility. Okay, but if there's zero correlation between your assets, so that's rho equals 0, you should notice that your variance also goes to 0 for your portfolio. And that's why it converges to 0. Okay, so this, again, is just demonstrating that there is a limit to your diversification depending on how correlated, the correlation structure between your stocks. Okay, so if there is in the case in which all stocks have a correlation coefficient of 0.3, you'll see that you can diversify away a certain amount, right, by adding stocks into your portfolio, but you can't eliminate anything beyond this without changing the correlation structure. So anything that's left is what we term the systematic risk, the undiversifiable risk, and this is the risk that should be used to determine our discount rate for risky returns. Okay, so to summarize again, the punchline for diversification is that this method or this strategy to eliminate a source of risk is accessible for all investors. And if we were to believe that investors are capable of diversifying away this particular risk, then our model to calculate the cost of capital for equity should not incorporate diversifiable risk. And therefore, we need a model to eliminate this diversifiable risk and incorporate that into the market portfolio risk, the market portfolio return, which we will talk about next week. All right, so to summarize what we covered today, I introduced to you the concept of risk and return, and we started building a mathematical model to represent risk through variance and also return of an asset through mean return. This required us to discuss the concept of probability distributions. Of course, we will not work with continuous probability distributions due to its mathematical complexity, and I leave that to other professors to test you on that. So long as you understand how to use discrete probability distributions to calculate variance and mean returns, you should be fine. Typically, to remind you again, we don't observe population or the true variance or true mean of an asset. So what we have to do is we have to rely on historical data, but there is a limitation because we may not have a long enough history. And sometimes some history may not be representative of the stock's true riskiness or variance. Okay, so we may have to take certain window of time and deem it more relevant than the other time periods. This is again the art side of finance, and it really depends on the corporate finance practitioner whether or not you decide to estimate the mean return using a subsample rather than the entire history. So next week I will talk about efficient portfolios of risky assets, portfolio choice and Sharpe ratios, and ultimately our asset pricing model that we're going to use to come up with a discount rate for risky return. Okay, so that's it for now. If you have any questions, feel free to leave a comment below or send me an email. That's it for today, and have a nice day.